Hello, everyone. Today is Friday, November 15, 2024, and I'm Brian Tokuge, Portfolio Manager at the Rice Partnership. I have with me Orest Saikevych, Chief Investment Officer of the Rice Partnership, who will be talking about the post-election implications for the financial markets. Hello, Orest.
Hello, Brian. Hello again, everyone.
Thank you for joining us today. So now that we know Donald Trump will be our next president and the Republicans will control Congress, how will this composition affect the financial markets?
Okay, Brian. Well, the implications are kind of being sorted out, but I think we know some general guidelines, and I guess the best way to describe it is the acronym TDIT for taxes, deregulation, immigration, and trade or tariffs. Taxes and deregulation are, certainly positives for stocks in particular. Immigration and trade, perhaps less so. Our feeling is that probably the tax portion will go through first, even though it'll probably take most of next year to accomplish using the 2017 guideline, the first year of the first Trump term. It appears it'll be passed by the end of the year. So that should help stocks. Corporate tax rates will come down. Individual tax rates will come down. Deregulation should help, in particular, financial firms such as banks. Immigration and tariffs or trade may be more protracted in their implementation, and we don't, we have kind of like guidelines how far they may go, but there's no guarantee they'll get that far. That might be more of a 2026 event. Net for stocks, it's a positive over the next year or two. For bonds, especially longer dated treasuries like 10 to 30-year treasuries, it's a minus because inflation will probably start creeping up again, and there are feelings that the budget deficit may not be reduced, but may get worse.
That's really interesting. So with that, what is the Rice Partnership doing to take advantage of these implications in the market?
What we've been doing is, in particular, adjusting our holdings in the international equity area. There are three regions of the world that appear to be most likely to be impacted by Trump tariffs. One is China, two is Mexico, and three is the Eurozone. China, fortunately, we don't have any major investments in China, so that's a plus. Mexico, we did have ETF in Mexico. We have sold that because as I mentioned, they're going to be impacted, we think, in a major way. And then the Eurozone, we had one small investment in the Netherlands, which we have since sold. There are countries we feel will be net beneficiaries. One is India, which we have our largest holding in. We still like India. Japan, which we've switched to a currency hedged ETF, in that any weakness in the yen won't dilute the overall returns of the investment. And then finally, we put a little bit in Switzerland, because even though that's a European country, it's not part of the EU. They have their own currency, the Swiss franc, which is strong, and it's not a major trading partner of the US. Okay, one other country, Australia, we are keeping because that's also a relatively strong currency, the Australian dollar, and they're not a major trading partner of the US as well. We've put the funds that we're not reinvesting in international in a mid-cap ETF. We like mid-caps as opposed to small caps, because mid-caps basically are less interest rate sensitive, they're more profitable, and they also derive most of their earnings from the US. So that's some of the trades we've done. On the core equity side, we've tried to emphasize companies with more domestic revenues and companies that are away from the trade scene. And also we're reducing healthcare because of the possibility that there might be major changes if RFK Jr. is the new secretary for the HHS.
Cool. Well, thank you, Orest. We really appreciate your time and your commentary on the post-election implications for the financial markets. And to everyone viewing, thank you for watching.
Thank you. Take care. Happy Thanksgiving, everyone.